US inflation spiked to 4.2% in April, and while this was expected, it has triggered a market sell-off. So I thought it might be interesting to look at which stocks have been affected, but also dig into those inflation numbers to see where they come from. Now, if you do want to learn more about investing, this is the kind of thing we discuss all the time in our free weekly market roundup. And if you want to learn more about that or sign up, you'll find a link beside me and in the description below me. So let's look at the inflation numbers in a bit more detail. This is not a recommendation. If you want advice tailored to your specific circumstances, seek independent financial advice. Let's start by looking at those inflation numbers. Here's the report that was published from the Bureau of Labour Statistics, and you can see the number which has got everyone worried, which is this 4.2% year-on-year increase in inflation. And as the report says, that's the biggest 12-month increase since September 2008. Inflation is measured as the change in prices for a broad consumption basket for a typical US consumer, and here are the components broken down. And in the first block that you can see here, that's the columns from October to April, that's a month-on-month seasonally adjusted change. And then the final column is the year-on-year change. So there's the headline 4.2% in the top right, and then it's broken down by category. So we've got food, energy, and then all items less food and energy, because that's the less volatile core version of inflation. Now, you've probably spotted the huge change here is for gasoline, which is up almost 50% over the last 12 months. And the other large change is in used cars and trucks. Along with that very dry text release, they published some nice graphs, and here you can see the effect of energy if you break down the components of inflation. It really does stand out amongst the other components. Now, in a previous video, I mentioned base effects on inflation, and here's one of those huge base effects that we get for the energy price. So in this top panel, you can see the price of West Texas Intermediate crude oil in dollars per barrel. And this vertical dashed line, which you can see next to me, is where we were exactly a year ago. And if you remember, that was just after oil prices turned negative in the futures market. That would have been around here on the graph. And the price of oil was depressed due to lack of demand. That's because many of the people across the world were locked down in their houses and traveling a lot less. Now, naturally, once those lockdowns end, people get back in their cars and trucks, and consumption of fuel increases. And that increases demand, and it increases prices again. And sure enough, we've seen oil prices accelerate as we've seen the vaccination programs roll out successfully across much of the developed world. And in this bottom panel, you can see the year-on-year change in the price of oil, and we had oil deflation for a very long period of time. In other words, year-on-year changes which were negative. So this is a classic base effect. Weak prices a year ago, stronger prices now, and then year-on-year increases of above 100%. And that's pushed up the rate of inflation when it incorporates the price of energy. In addition to those base effects, we've also had bottlenecks in supply. So as demand increases, some suppliers just haven't been able to keep up with the pace of that demand, and consequently, that's pushed up prices. And as Julia Coronado has pointed out in this tweet, that's caused some surprising increases in prices of goods and services. And one example is the new car market. New cars require new chips, and if you can't get those chips, that has squeezed supply. So people perhaps are turning to the used car market, which might explain why those prices have increased so quickly for used cars. And you can get subcomponents of CPI. Here we've got used cars and trucks, which is just increasing very rapidly, whereas price increases for new cars has been very muted in comparison. Now, we might expect other goods that require computer chips to have similar squeezes, such as computers, gaming systems, and TVs. But so far, I haven't been able to find those increases in the latest data print. Now, whenever I make these videos about inflation, someone always complains. They say, of course, if you strip out food and energy, that's going to reduce inflation. Not true. What it does is it strips out the volatility of inflation. Here are those two versions of inflation, one with food and energy, one without. So with is red, without is blue. And you'll notice that the blue line is much less volatile than the red one. While you do get these huge deviations from the blue line, eventually headline inflation, which incorporates all the components, snaps back into line with the blue line. And if you're basing policy on inflation, then you want a less volatile measure. So that's why the Fed focuses on CPI less food and energy. And the latest inflation print is a very good example of that. You can see if you do include fuel, there's a massive increase in inflation, whereas if you exclude it, the increase is much smaller. So the purpose of that exclusion is to rule out transitory effects, which don't affect inflation policy. Now imagine the Fed started to freak out every time it saw a very big spike in oil prices. That would be crazy because it could stifle any kind of recovery in the economy. That's why they have to look through the volatility and look at core inflation, because that makes for good policy. Now let's look at the market reaction to that inflation number. Here are the one-day returns around the announcement of inflation at 4.2%. And I've broken it down by sector, and you can see the only sector which cheered the inflation number was the energy sector because oil prices rose. The sectors which had the largest negative reaction were the ones that were either very overpriced or the ones which were very sensitive to interest rates, and that would tend to be growth stocks. So consumer discretionary, which is dominated by Amazon, for example, had a very large negative reaction, as did tech stocks. Both of those fell by about 3%, whereas financials sold off a lot less. Valuations aren't so high in that sector, and also financials benefit from a steeper yield curve. If we look at the FactSet data for the expensiveness of different sectors, you can see my point about which sectors sold off most. Financials at the moment have the lowest price to forward earnings ratio, so they are the cheapest sector, both in absolute terms, but also relative to their 5-year and 10-year history. So the most recent price to earnings number in this graph is the dark blue bar. The 5-year average for that sector is in light blue, and the 10-year average is in green. So for financials, you can see it's close to the 5 and 10-year average, so not particularly expensive. Whereas if we look at these sectors on the left-hand side of the graph, such as consumer discretionary, which sold off a lot, and information technology, which sold off a lot. These are high on an absolute basis for price to earnings, but also relative to their 5 and 10-year average. Now, the whole justification for having very high price to earnings multiples for the US was that interest rates were low. And if inflation surprises on the upside, then that increases the chance that the Fed will hike rates sooner. And that would tend to normalize these very high valuations more than it would for more reasonably priced sectors. So what this is showing us is that the day of reckoning is getting closer for valuations to snap back to reasonable levels. And overpriced sectors are going to be impacted more when that happens. How about the bond market? Well, this is the US 10-year Treasury yield. Remember, if the yield goes up, the price of bonds goes down. And we've seen a fairly brutal increase in yields. And in fact, they've almost tripled from summer levels last year to the most recent levels, which is about 1.7%. But really, there wasn't much of a reaction so far to that high inflation number. Perhaps that's because people have already priced in very pessimistic outlooks for inflation into the bond market, more so than they had into the equity market. But certainly if inflation carries on surprising to the upside and it looks like it's not transitory, then we would expect to see bonds sell off further. Or if we saw very strong growth confirmed in the GDP numbers, because both growth and inflation tend to push up yields and push down bond prices. So the big question is whether this is going to be a transitory increase in inflation or something which lasts much longer. Certainly some politicians, such as Senator Pat Toomey, think that this is showing that the Fed is asleep at the wheel and that it's time for the Fed to revisit its accommodative policy stance. In other words, they should be raising rates. But the Fed's made it very clear in all of its communications that it does not want to do that. It no longer depends on inflation forecasts. It actually has to see the whites of the eyes of inflation averaging significantly more than its 2% target for some extended period of time in order to raise rates. Why? Because it doesn't want to cut off a recovery just as it's getting a little bit of traction. Here's what Lael Brainard has to say about that.
Achieving our inflation goal requires firmly anchoring inflation expectations at 2%, Following the reopening, there will need to be strong underlying momentum to reach the outcomes in our forward guidance. Remaining patient through the transitory surge associated with reopening will help ensure that underlying economic momentum that will be needed as some current tailwinds shift to headwinds isn't curtailed by a premature tightening of financial conditions.
Now, Lael Brainard was talking there about anchoring expectations. What was she talking about? What I'm showing here are 3 measures of market expectations of inflation in the future. And what I've shown is how those expectations have evolved from the early 2000s here on the left of the graph all the way up to the present day. And what you can see in the top panel is the 5-year break-even inflation. So that's market expectations over the coming 5 years. And the dashed red line is the Fed's average inflation target, which is 2%. And while it has exceeded that amount, it's only at about just over 2.5% at the moment. So I'd say that's fairly good evidence that expectations have anchored at the Fed's target. And that means that the market believes the Fed is credible. They don't think that the Fed will let inflation get completely out of control. The middle panel is the same thing. It's break-even inflation, but measured over a 10-year period. And again, you can see even over that period, the expectation is that the Fed will keep it at around 2.5% at the moment, although that is increasing rapidly. So I'd certainly keep an eye on that to see whether that continues rising. My expectation is that that'll slow down. And then this bottom panel looks even further out. It looks at expectations of 5-year inflation as measured 5 years in the future. So this is called 5-year inflation. And again, you can see that remains fairly well anchored around the Fed's 2% target, although that too is increasing quite quickly. So I certainly wouldn't be panicking about inflation as we are now. I'd be monitoring those numbers certainly to ensure that inflation expectations remain anchored and that we don't have consistently high inflation, which would force the Fed to act and trigger a potentially much bigger market move downwards. I would be concerned if I had a large exposure to growth stocks because I expect this dynamic for increasing US growth to continue, and that would push up yields and push down interest rate sensitive stocks like growth stocks. So this rotation into value is probably a story that'll pan out for some time to come. Well done for getting so far into the video. I assume that means you like our content, so why not support us? If you do that, you get a beautiful icon next to your name in YouTube, and when we have a YouTube live, we'll answer your questions at the front of the queue. We'll answer your questions first. So if you want to do that, just click on the link beside me or on the join button which is underneath me. And as always, thank you for listening.